The U.S. labor market experienced a notable slowdown in July, with only 114,000 jobs added and the unemployment rate climbing to 4.3%. This unexpected cool-off has raised concerns among traders and economists, prompting speculations about potential interest rate cuts by the Federal Reserve. Treasury yields and stocks have tumbled as a result, indicating growing unease about the country's economic trajectory. As the Federal Reserve navigates these turbulent waters, the balancing act of fostering economic growth while curbing inflation becomes increasingly precarious. Can the Fed steer the economy toward stability without triggering a downturn? U.S. economy cools more than expected in July, with 114,000 jobs added. In an unexpected turn of events, the U.S. labor market has shown signs of cooling down significantly in July, with the addition of only 114,000 jobs. This figure falls short of the anticipated 175,000 positions, marking a stark contrast to the robust average monthly gain of 215,000 over the past year. The Bureau of Labor Statistics, BLS, also revised June's figures downward to 179,000, adding to the concerns. As the unemployment rate climbed to 4.3% for the fourth consecutive month, traders began to speculate more aggressively about potential interest rate cuts by the Federal Reserve. Market reactions and speculations. The latest job report triggered a notable reaction in financial markets. Treasury yields and stocks saw significant declines as investors adjusted their expectations. Futures market traders, who had previously anticipated a reduction of just over 0.75 percentage points in interest rates this year, have now priced in a full percentage point cut. This implies the possibility of 1 or 2 half-point cuts within the remaining 3 meetings of the Federal Reserve before January. Federal Reserve Chair Jay Powell, however, stated that larger moves were not currently under consideration. Austin Goolsbee, president of the Federal Reserve Bank of Chicago and an alternate voting member on the Fed's Policy Setting Committee, emphasized caution in responding to 1 month's data, although he acknowledged that the Fed must act if unemployment rises significantly above 4.1%. Economic indicators and sector performance. The 2-year Treasury yield, which closely aligns with interest rate expectations, fell below 4% for the first time since May 2023, closing at 3.89%. In response to the jobs report, analysts from J.P. Morgan and Citi adjusted their forecasts, now predicting up to 5 quarter-point rate cuts this year. Stock indices reflected the market's unease, with the S&P 500 recovering some losses but still closing 1.8% lower, the Nasdaq Composite dropping by 2.4%, and the Russell 2000, which includes small-cap stocks more sensitive to domestic economic conditions, falling by 3.5%. The broader market sell-off was further fueled by disappointing earnings reports from consumer and tech companies, intensifying fears of a slowdown. Labor market and Federal Reserve's approach. Despite the underwhelming job growth, economists like Derek Tang from LH Mayer and Ryan Sweet from Oxford Economics urge caution in interpreting the labor market's health based on a single month's data. They suggest waiting for more consistent trends before making definitive assessments. The Federal Reserve, which recently held borrowing costs at a 23-year high of between 5.25% and 5.5%, might consider rate cuts in its upcoming September meeting. This timing is particularly significant as it precedes the November presidential election, where economic performance will be a crucial point of discussion. Fed Chair Powell has acknowledged the substantial reduction in inflation from its peak in 2022 towards the 2% target. He indicated a shift in focus, no longer requiring additional evidence of a weakening labor market to confirm that inflation is under control. Powell also expressed a desire to avoid further significant cooling in the labor market, aiming instead for a soft landing where inflation falls without triggering a spike in unemployment. Political and economic implications. The goal of achieving a soft landing remains challenging. Historically, efforts to cool an overheating economy have often led to recessions. The current scenario, with the Federal Reserve attempting to balance economic growth and inflation control, has heightened market anxieties. The stock sell-off on Friday, partly driven by weak manufacturing data, underscores these concerns. Prominent political figures like Senator Elizabeth Warren have criticized the Fed's approach. Warren accused Powell of making a serious mistake by not cutting interest rates sooner, warning that prolonged delays could steer the economy into recession. Sectoral analysis. The July jobs report highlighted mixed performances across various sectors. While healthcare, construction, transportation, and warehousing saw job additions, manufacturing, retail sales, and leisure and hospitality sectors experienced stagnation. President Joe Biden acknowledged the slower job growth but emphasized the strength in business investment. Average hourly earnings rose by 0.2% in July, translating to a 3.6% increase over the past year. Despite concerns about a potential economic slowdown, the Bureau of Labor Statistics reported that a hurricane impacting Texas had no significant effect on the data collection process for July's job report. However, economists like Thomas Simons from Jefferies expressed skepticism, noting the high number of workers reporting weather-related disruptions, which might have influenced the overall employment figures. Conclusion. The latest employment data paints a complex picture of the U.S. economy, revealing both areas of resilience and concern. As the Federal Reserve contemplates its next moves, the stakes are high. The challenge lies in balancing rate cuts to support growth without igniting inflation or triggering a recession. How will these economic dynamics unfold, and what strategies will prove most effective in steering the economy towards stability? Share your thoughts on the potential paths forward and the measures the Federal Reserve should consider.